Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I'm going to move ahead. I was talking about sequence of returns and what impact that can have as you're heading into retirement in particular, or you're in retirement. Sequence of return can be devastating in terms of your what happens. So this is why when we're on the cusp potentially of a bear market, that we want to look at how do we have in fact hedges in place to protect us against that down market? Are we able to, in fact, have income provided that we need without having to sell off shares in our portfolio that could cause us to get behind the eight ball, if you will, meaning that if you're selling off shares and those shares are going down in value, but you need that income, so you're having to sell them, you're going to have fewer shares at the end of the day, right? At the end of a bear market, you get fewer shares. So even if those shares now go up in price, unfortunately, you don't have as many, so you're not going to recover as quickly. Tony Robbins talked about in his book with regard to sequence of return, to use a great example. You can have two different investors, 8% average return for both of them. I know a lot of you out there watching are probably thinking 8%, wouldn't that be great? 8% return. One is broke in 20 years. All right, taking a 5% distribution rate. Why? Because he went through a bear market when he started at the beginning of retirement. The other went through a bull market at the beginning of retirement. Same return, average return over the same 20-year period of 8%, also taking 5% out of their money. The difference there being that at the end of that period, not only did they take out about 60% more with regard to the income they got, but they still had money left, a lot of money left. In fact, I think it was about $1.5 million left. So this is a huge risk here called sequence of returns. And the longer we live, the more of an issue this can be. And when you're investing, it's so important to protect yourself then against minimizing the amount of a drop in your portfolio. The other part when it comes to planning is having income that you can get from your portfolio. So an example, if I've got a client that's, because I don't know what, and none of us have a crystal ball. We don't know, I'm giving you some indicators, some things that should be cautionary tales of what, everybody's been expecting and could be upon us. So this is the part that you take away, though. It's a good time to look at what you have and understand what could happen and if the market, in fact, does go through this bear market cycle, which we're overdue for. If it does, how much might your portfolio drop? How long would it take to recover? Do you need to take income or money out of that portfolio during that period? This would be a great time to employ some strategies to help protect yourself. I have a lot of clients coming in that are concerned about the presidential election, what impact that's going to have in the short term. So I'm going to share another one with you. Let's go ahead and put the presidential cycle turn. So this is an area we thought, well, let's take a look at it historically, in other words. So what we see, in fact, is that in the first quarter or two after election, if the incumbent party wins, it actually tends to be more positive on the market than if it's the other way around. All right. However, that's just in the first quarter or two. So that means if basically in this situation, if Hillary were to win, then the expectation would be historically that at least for the balance of the year, we would see more of a positive, maybe even into the first quarter of next year, a more positive result. However, then in quarters 3 and 4, that changes. So depending again on now again, this is based on what's happened in prior elections going back, I think to 1896. All right. Now here's the other end of that. What's going to happen in the middle of this after the election, which is a bigger concern, is that the Federal Reserve is most likely going to raise rates. How do you think that's going to affect the market? If it's anything like last year, it would have a very negative effect, so that could have a big impact on what we're seeing today with regard to the presidential cycle. Here's some other things to consider. How is it going to be, how does the markets perceive who wins based on the incumbent? Do they see that as a good thing, more of the same, in other words, potentially? Or do they see it as a negative thing where they're going to say, well, do we really want more of the same when we look at what's going on in the markets today? All right, so this is a quarter again. This chart is showing average Dow gain when incumbent party wins in the first quarter, 7% versus the average Dow gain when the incumbent party loses, which is a -1. Then in the second quarter, you see again it +1 versus a -2, and then it flips. See how that works? Then the third quarter, it goes the other way. The incumbent party, if the incumbent party loses there, the gain that could occur from that third quarter and again in the fourth quarter as well. So what we're seeing basically, it's kind of interesting. It's, to see these statistics, but how much value are they really when it comes to investing? Here's the part I'm going to get into. When I look at it, there's some subtleties to this that go beyond just who's going to win, all right? More of the same or totally new, different, and whatever that might look like. So what we look at is policies. One of the things that comes in there is from the stock market standpoint, one of the things that would come in there, if we've got more of the same, that would be we've had a lot of, not a lot of growth, not a lot of improvement, and it's made it tougher on the Federal Reserve, which means that the Federal Reserve, in trying to normalize rates, we're seeing this really adverse effect with regard to the market. Now, if we had a stronger growth going on in the market, okay, or in the economy rather, which would then have also a positive effect and lower corporate rates, that could help hold up. Basically, those policies could help the market strengthen and allow the Federal Reserve then to make the changes they've made. I think it was Janet Yellen again, I believe last year, saying one of the difficulties is some of the regulatory environment and government policies are making their job, the Federal Reserve's, harder because of what they're doing and weakening the economic growth versus strengthening it. So here's the other part of that. Looking forward. So short term, we don't want to focus on too much other than if you know you're going to be taking income, we may create a different pool of money. You've heard me talk about the importance of having an emergency fund and a short-term fund. This is where that short-term fund can come in. We're going to be more conservative with my clients when we're looking at income we're going to need over the next 3 to 5 years. As an example, we have a pool of money that we have invested differently to provide that income than, say, the money that we're looking at more long-term. In particular, money that we know we're not going to need to touch for 10 or more years. There we can put together a portfolio design that's quite different and allows for more growth because we know we won't have to touch that money. A lot of times we create buckets or pools, if you will, of investments or investment portfolio design wherein we have income laddered up so that we have income over a 3 to 5 year period, over a 5 to 7 year period, and so on, 4 to 7 years, depending on that plan. We tweak that out in such a way that we make sure you've got the income you need in such a way that it's going to have the least effect if we go through a bear market. In other words, you're going to be able to weather that, and it's not going to hurt that pool of money that you need for income. There's other things that we use for hedging strategies that happen to do well in bear markets. So when when we look historically and we see times when the stock market has dropped, there are investments out there that in fact go up in bear markets. So when the market's going really strong, these investments don't typically do as well, but in a negative market they do extremely well. They typically make money when the market is dropping. That can be a huge hedge or a huge way to protect your portfolio, if you will, during these downturns. One of the things to look at there too, when you look at average return, over the last, they're talking about again average returns over the next 20 years. So let's take a look at this next one. The next slide. After an era of stellar performance in this regard to investment returns are likely to come back down to earth over the next 20 years. And this is from McKinsey Global Institute, this particular analysis. And this is interesting because, as I've mentioned, we've had others like Vanguard, like BlackRock, the largest money manager in the world. They're the ones, in fact, that manage the retirement accounts for the federal government and federal employees and the military and the like. So one of the things they're all saying is low returns, and they were talking more with regard to U.S., or at least Bogle with Vanguard was, but this and Shiller's index is showing similar things. But take a look at this. In the past 30 years, showing U.S. equities, both U.S. equities and European equities, as well as U.S. government bonds and European government bonds. Now, this is the thing we're looking at. So in the blue, we see what it's done over the last 20 years, and that's been pretty good. Now, think in terms, again, most portfolios are going to be a 50-50 design of stocks to bonds. So if we take these averages and we blend them together, we see that we have an average return over the last 30 years of somewhere in that, on a balanced 50-50 portfolio of around 6 to 6.5% average return per year. But now look at the growth recovery scenario and the slow growth scenario. So they're looking at two potential situations here, and what we're seeing as the more likely is a 4% average return, and again this has been supported by others as well, and on the European possibly 4.5, which tend to be a little more risky of course as well. And then look at our bond portfolios down at that 1.7, 1.6 range. Now if we blend those two together, we see more of a return of about 3.5%, 3 to 3.5% as our average return. This is the part now. We look at that, and let me take that slide away for a moment, and let me talk to you a minute. Think about this. All right, so that's showing this. There's a lot of research giving us a lot of information that we can implement, and this is the key. I'm not providing this just for, that's interesting. We want to take action about this. How to do that? What do we do about this? How do we, protect ourselves? Is that going to be enough money to stay ahead of inflation and taxes, for instance? And if not, how can we in fact improve our returns? And portfolio design is critical to that. Now, here's another part when we're looking at these kind of returns. And we're saying, is this real? How real is this? Is this just some, not to be paid attention to? Well, let me share some other statistics with you. From 2000 through 2015, all right, the stock market, basically the S&P 500 index, and remember what I said about the S&P, outperforms, right, 80 to 90% of equity mutual funds. So if you're invested in mutual funds, this would mean that you're probably not doing as well as the S&P. Unless, of course, you have the S&P 500 index as the big part of your portfolio. So if that's the case, think of this. From 2000 through 2015, the return was less than 4% on average, all right? Average per year. Now that means what we saw, in fact, right, we had that bear market from 2000 through 2002 where the market dropped 44%. We had a recovery from 2003 through 2007. Then we went into another bear market period and it dropped again. All right, then we're basically in the market for the first 10 years, and we're at about a break even, the first 10 years of this century. And then in the ensuing years, we had a nice little run up, and in the end of it all means that we've got an average of somewhere around 3.5 to 4% return on our portfolio, and that's if it was 100% stocks. If you had a stock bond mix, you may not have done quite as well as that. These are some things to understand. Yes, it's very possible, but there are some ways that we can improve that picture for you. All right, and I'm going to talk to you about that when we come back. Join us here. We'll be right back on the Retirement Report.